Betty, second. Any corrections, concerns? Okay. All those in favor, please say aye. Any nays? Okay, moving on. We are at informational items. We have the monthly financial report. Julie?
Thank you, Madam Williams. Hello. Today we have August financials before you. We are supposed to be about 67%, 66.7% to be exact, of the budget expectations. As I looked over the financial reports today, I just had a couple of things I wanted to highlight. The monthly financials, we always make sure that all of our major revenues are accrued monthly. So trying to not have any major surprises at the year end. And same with expenses. So what we present on a monthly basis should be a pretty good snapshot of where we are as a county and at the general fund year to date. One thing that has been prevalent in this year so far is that compared to budget revenue allocations, we are receiving good revenue for PPRT, state shared revenues, sales taxes, and interest income. If you want to read for IML, has their September monthly edition, and that will give you a little bit more information on some of the state shared revenues. For time, I will not go into detail with that. Property taxes, we receive them starting in June, and the highest month we receive is in June and September, followed by July and October. So far in intergovernmental revenues, it does show that we are below budget, but that is primarily, again, because we have ARPA in there, and we have a good expectation of 23.9 in revenues. However, year to date, we've only spent 2.1 million. So for ARPA, the ARPA revenues for the federal government is the same as the expenditures. The only surplus would be the interest income, which so far is about 1.2 million. For charges for services, we are on track for anything that's a fee type. The exception, we have reimbursement for engineering and construction for highway projects that will start to catch up. The majority of that revenue is actually going to be recognized during the annual audit, because that's when we go through and double check all of the capital projects that have been done today and recognize the revenue that has been earned through the year. Beyond the rest of for general fund, everything looks normal. And that's all I have for you guys today. If there's anything specific that you would like me to bring up during the monthly financial report, I would love some feedback, or if there's a question that you see ahead of time, you can shoot me that question, and then I'm happy to have that answered and then presented with you on a monthly basis. Trying to give you some excitement to a normal monthly report. If you have any questions, I'm happy to answer.
Any questions for Julie? No questions, thank you.
Okay, great.
Moving on to Headington Oaks financial report. Heather?
Thank you, Madam Chair. The monthly report is for August in your packets. I just want to point out, this includes the write-offs that were approved by the board in August, and transitions hospice final payment. We're working with Molina. They're one of the Medicaid accounts that we have. We're in negotiations with them right now with our consultant. And I have another meeting with them scheduled next week, and I've been working with the state's attorney's office on that. And once we get to a closer number, we'll come to the board with that as well. HFS is still reviewing. The third party that our contractor had contracted with at no cost to the county had submitted all of the bills, and there was a glitch in HFS system, so they're resubmitting all the bills. They got kicked back to them. So again, taking a little longer than we anticipated, but we're moving.
Any questions for Heather? Okay. Next is the October 2023 Accounts Payable Review.
The very detailed report is in your packet. If you have questions on anything specific, please let me know. Or if there's anything you want us to look at, dig deeper, let us know that also.
Are there any specific questions regarding October 2023 Accounts Payable? Okay, thank you. Moving on, resolutions, extension of external auditor services. I need a motion to get this on the floor. Danny Phelan, Brandy Bryant, okay. And go ahead.
Okay, thank you. So normally in the fall, we would put out an RFP for the external audit firm. We're currently working with Sikich LLP, and they have been working with us for the past several years. A couple of years ago, prior to my coming on board here in November of 21, so right before I started here, there was a board-approved 2-year contract extension with Sikich to allow them to help both with COVID and, more importantly, the transition from our Penimation software system to the new Munis system. We did the audit earlier this year. I think at the time that the initial request was made, they thought that we'd be past that transition phase. But fiscal 23 is really the transitional year for us in this new system. We did most of the audit out of Penimation for fiscal 22 because that's where all of the detailed records were kept. And so along with that, there was a significant change in our chart of accounts. And so Sikich was on board with us for that. We also have an external consultant, Matt Cook, who helps us with our financial statements. We're one of only 5% of governmental bodies that does our own financial statements. Most people have the auditing firm do them. And so that adds an extra complication in there. Sikich understands what we have done with the transition in our chart of accounts, as well as that with the fund change with both Headington Oaks and the risk fund. So at Matt Cook's recommendation and our comfort level, we are requesting that the board grant us a 1-year final extension with Sikich to help us close out this fiscal 23 audit. And then in the spring of 24, we'll put an RFP out for the next audit firm.
Okay. Scott, could you make a little comment on the audit, choosing of the external auditor and the whole process?
Happy to, Madam Chair. Board members that have been on the board for a number of years remember that this was an important topic for former member Alan Mayer to go through a rotation policy. We were really asking for this one deviation from that for the reasons that Heather's articulated. Even though I've not spoken to him, I'm confident that if I did reach out to Mr. Mayer, he would agree that these are some pretty valid reasons for doing so. Also, as Heather said, we're one of less than 5% of governmental entities that prepare our own financial statements, and then the contracted third-party external auditor audits those financial statements. The other 95% that contracted external auditor does both the preparation of the financial statements and audits those financial statements. And, that's how we were before we had a finance department. But a key directive from the county board when we created the finance department was that we were going to prepare our own financial statements. And it's a significant lift to do that every year, but our team is very well qualified and capable and does that successfully, to the point that when you go back and look at our audits from the external auditors, I can't remember the last time we received something other than an unqualified opinion from the external auditor, and that is Sikich or Baker Tilly, who was before them, or before Baker Tilly, it was Clifton Gunderson, now Clifton Larson Allen, where the unqualified opinion is the highest possible rating that an external auditor can give to an audit document. That helps drive the treasurer's ability to, in some cases, to get favorable interest rates because they know that we're a well-qualified organization. It also matters substantially in those rare occasions when this body chooses to go and issue debt. We have the highest possible rating that you can get for a bond rating that is, given the current kind of fiscal condition of the state's pension system, we have a bond rating that's one notch below AAA. If we had, maybe 100% of expenditures in reserves, we maybe could get a AAA rating, maybe not, but then we'd be having a different conversation about why we have 100% of all of our expenditures in reserves. So, this committee, on behalf of the board and your finance team, has done everything necessary to make sure that there are checks and balances in place. We have segregation of duties, and several members of the organization, including myself, are interviewed annually to talk about fraud risks and what those fraud risks might be. And then the external auditors look at all those things, test our financial statements, and come back with that unqualified opinion, the highest possible grade that we could get on an external audit.
Thank you for that. Are there any questions regarding this resolution? Paul?
Thank you, Madam Chairman. The only question I have is why are we, if we're going to use the same one and you use the excuse I read here that we couldn't get somebody, would have to put an RFP out and it'd take longer, why are we waiting till now? Why didn't we bring this up a couple months ago to do it? That way, if the board decided not to go with this, we would have had ample time to put the bid out. That's my only question. It just seems a little late on that. In the thing of transparency, that would look like possibly, especially with what we've had the trouble with the auditor, that we were trying to hide something. Not that I think that we are or anything, it's just one of those things. I was just curious why we took our time and didn't bring this up maybe a couple months ago. So if the board would want to look out, why we didn't do it then.
It's up to you. I mean, I have not gone through an RFP process before for audit. And as we were leading into the budget in September, I did not recognize what a wide timeline there would be. And then during the budget process, we uncovered issues that we think are going to be a challenge if there's a new external auditor that comes in. The highest risk of audit failure is in the first 3 years of a new contract. And I feel that this audit firm understands us and they know our ins and outs, and they can dig deep and they understand the transactions. And so that's why I didn't bring the RFP process before now.
Any other questions? Okay. The resolution for extension of external auditor services. All those in favor? Aye. Are there any nays? Okay, thank you on that. Next is general fund annual surplus policy. Can I get a motion on the floor, please? Linda, second Brandy. Okay.
Okay. I have a presentation that I'd like to go through. A slide deck. Do you have it on that up there, or I can come up there if that's easier? Thanks. We thought it would be easier, since these next three resolutions are intertwined and are approaching the same strategic initiative of the board, to kind of lay out the whole thought process and the strategy behind it. So I will go through the presentation.
While we're waiting for the slides to come up, I just want to thank Scott, Heather, Julie, the team. They really put a lot of work into coming up with our strategy for paying off the Headington Oaks bonds in 9 years. So I really appreciate you guys kind of thinking outside the box and putting this in place.
Thank you. Okay, thank you. Okay, thanks. This is the moment in life where I realize I should probably get my eyes rechecked for distance. So I'm probably going to turn a little bit when I'm presenting here. This, as I mentioned, is a recommended strategy for meeting the board's strategic initiative number 18, actively monitor refinancing opportunities for Headington Oaks debt repayment. You can go to the next slide, please. So just a high overview. The Series 2022 General Obligation Refunding Bonds are for the former Headington Oaks facility. They're callable in December of 2032, which means we cannot do anything with making any extra payments. We just make our regular principal and interest payments as scheduled until December 15th of 2032, and then the board can decide at that point in time what they want to do. But it's not like a home mortgage where you can pay ahead of time and pay it down early. The principal balance at that time should be $11,075,000. So that's our target number that we're looking at today. And the current average interest rate on these bonds is 5%. Currently, the revenue that we have to pay for these bonds is a special revenue tax. In fiscal 24, and we recommend continuing this, to levy the full 6 pennies per $100 EAV annually. For next year, that revenue would be about $2.28 million. The debt payments next year will be about $1.6 million, and then operating expenses about $75,000. And if you'll recall, most of that is for the Center for Prevention of Abuse contract that we have. Any surplus at that point will go to the fund balance, which is currently a negative $3.9 million as of month end August 31st. Next slide, please. So we were given a challenge by the board to figure out what we can do to pay these off in December of 2032. There's 4 different options really that we were looking at. We can continue the current bond payment schedule and don't refund, and then just let it ride out through 2041 at 5% interest. Or you could pay down a the outstanding principal by the balance that will accumulate from the special tax revenue that we just talked about, which will leave about $8.2 million in principal at that point in time that you could either refund at that point, and or pay down a larger balance on principal and refund for a shorter time frame, or pay off the principal and bonds in full. Our understanding is that this board is hoping for option 4. That's the goal. Next slide, please. Thank you. So we have several different moving parts to this, hence the 3 different resolutions before you today, and a couple other factors. And the first low-hanging fruit, I guess, would be to transfer the remaining budgeted funds from this fiscal year from the referendum eliminated auditor's office. It'll be about $30,000 directly to the long-term care services fund. That will contribute to paying down the negative fund balance. And then in fiscal 24, we had budgeted $94,200 for that office to do the same with those funds. Next slide. Then the bigger one is to adopt a policy for an annual transfer of 50% of the fiscal year's surplus from the general fund. Transfer that to the long-term care services fund until there are sufficient reserves to pay that $11,075,000 principal balance. And that's one of the resolutions before you. If there's a fiscal year where there is no surplus, then there would be no transfer required. It wouldn't be that we'd have to transfer money back or anything like that. And then the policy will sunset once that threshold has been met. So, let's say we're not certain what the surplus will be for fiscal 23, but let's say it's $2 million of a surplus in the general fund. Half of that, $1 million, would be then transferred at some point in fiscal 24 to the long-term care services fund to start eliminating that debt. And then every year after that until it reaches that point. Next slide, please. So that's one piece of the strategy. The next piece is to amend the fiscal 23 payable 24 tax levy that the board approved in October to shift 4.5 pennies to the general fund to maximize it at 25 pennies. Right now it's 20.5 pennies and the maximum levy is 25. So we have run an analysis, a cash flow analysis on the IMRF, the FICA, and the risk funds, and we can sustain these amounts shifting 1.1 pennies from IMRF, 1 penny from FICA, and 2.4 from risk in fiscal 24 to shift that $1.7 million to the general fund. Then another resolution, the third resolution, would be authorizing Administrator Sorrell to transfer those funds to the long-term care services fund to begin reducing that debt and accumulating. IMRF and FICA have very healthy reserves. I believe one's at 101% and the other's at 80% right now. The fund policy is 8%, and our kind of internal comfort level, because I'm conservative fiscally, is 24%. So with this cash flow analysis, if we do this in 24, and then again, we'll recommend it in 25 when we budget a similar strategy, we will never go below the fund balance policy. There's a period of about 2 months where we'll get between my comfort level and the fund balance policy because of timing of when property taxes hit, but we'll never go below fund policy. This is another way. I know some of you have had questions about why some of our fund balances are so high and maybe start spending down some of those reserves. That's another way we can accomplish both of those goals by doing this method and not raising property taxes. And then again, as I had alluded to, in 25, we would do a similar strategy. The cash infusion over this 2-year period would allow that fund to get out of the negative balance and then begin to accumulate and gain interest. So we've accounted for interest growth on those funds to help build that up to the $11 million mark. And then I've talked with Nicole in the treasurer, and she and I will work closely together on making sure that the funds are invested, in a strategic way over the next 9 years to help get the highest yield interest rate that we can. And then finally, we'll monitor the account. We'll report out to the board regularly. We already report out fund balances on a monthly basis, but I'm happy to do any other kind of reporting on this as we go forward. And again, as I mentioned, it just takes these 3 resolutions in tandem to accomplish this. So I'm happy to answer any questions that you have.
So if we do none of this, then we will have about 2 million to pay on those bonds in 9 years.
Correct. About 2.8, I think it
Okay.
comes to. Mm-hmm.
Okay. Are there any questions? Linda?
Can you explain where the negative 3.9 million is? I was thinking Headington borrowed from other county funds. Is that where?
So if you want to look at it this way, it's like Peddington has an IOU to.
But I thought we had a discussion that we were not going to pay back.
Well, it's right now the account is negative. There's no way we can just write it off to 0. There's no accounting legally way we can write the balance off. The funds have to be replenished in that account because they've been spent. So it's just been riding as a negative balance for what we've spent more than we've taken in that account over the years.
Okay, but the only way we're able to do that is to borrow from other specific county funds, correct?
Well, if we do it this way, it's not borrowing. It would be a transfer from the general fund because the Headington Oaks Fund would never pay it back. It's not borrowing. It's just
Okay.
paying off the debt.
All right. Thank you.
Mm-hmm.
Additional questions? Steve?
Sure, thank you, Ms. Chairwoman. I had the question, and I prompted Heather maybe to give us an update on, we had a discussion in the past around bringing excess funds back from other departments or elected offices, so at the end of the year, if they have a surplus, where general fund funded them to begin with, does that money come back to general fund? And how is that, those reserves that would come back to that surplus that would come back to general fund, are they included in this policy and resolution? So make sure they're truly captured. And I don't know if I'm saying that the best.
Sure. So I'll try to explain it the best that I can. So every year the board obviously approves a budget, and at the end of that year, any excess revenues that have been received and or any expenditures that have not been spent that were appropriated make up the surplus for that fiscal year. So let's say I'm just going to use my department, even though we're a small department. Let's just say the finance department didn't spend $50,000 out of their budget this year, and we had an extra $50,000 come in revenues. So there's $100,000 extra. We're funded with the general fund. That $100,000 goes back into the surplus of the general fund. And it's like that for every single department that is funded by the general fund. So a $2 million surplus is realistic, on the scope of countywide. So that is the surplus we'd be talking about. It doesn't go back to the finance department has a little sliver in the general fund that, it builds reserves year over year. It all goes back in total to the general fund surplus, if that makes sense.
Yeah. Scott, can you give us a historical perspective on surplus?
Sure thing, Madam Chair. So, as Heather just said, when we go through the budget process each year, a balanced budget is comprised of three components: revenues, expenditures, and, when appropriate, planned use of reserves. The best example of that is in our motor fuel tax fund or our county bridge fund, where we save up money over the course of time for a large bridge project or a large road project, and then we appropriate those through the budget process. What we're talking here operationally is, as Heather said, surplus comes in and is defined as when revenues exceed what we expected when we adopted the budget, and when expenditures come in less than what you appropriated during the budget process. And they stay within their individual fund. So, all the general fund departments, county administration, county board, finance department, planning and zoning, sheriff, circuit clerk, so on and so forth, they don't have individual departmental surpluses because we budget for and we account for at the fund level. So those all get rolled up into the general fund. But those offices that are not in the general fund, maybe it's the health department or care and treatment or the highway department, those are accounted for within their individual funds. So, if care and treatment, for example, which their revenues are the property tax levy and some PPRT revenues, and they're basically a grant-making entity. If the agencies that they make awards to don't use all those funds, then the unspent dollars and any excess revenue grows the reserves of the care and treatment fund. What we're talking about doing here is really just using a portion, 50% on any given year, of future surpluses in the general fund to help write down, or at least build the piggy bank up, so that when we get to December of 32, that county board will have the revenue sitting in the piggy bank to make a policy decision at that time as to whether or not they want to pay the remaining bonds off in full or not. And that will be a policy decision for that board, 9 years from now. And so, I think we'll continue to obviously monitor that as we move forward. We're always going to be able to project as we go through the course of any fiscal year what that general fund surplus is going to look like. And even in the worst of times, this board has taken action so that we generally do have surpluses in the general fund on an annual basis, even if they're very small ones.
Thank you. Steve?
Thank you for that response. Just to follow up, maybe for clarification, what are the allowable expenses that long-term services care fund can be used for? So in 2032, can that board say, hey, thank you for that, we're going to go out and blow this money or use the money effectively somewhere else. We don't want to pay off the debt. Can it be used other places? Can it be brought back in the general fund and reallocated, or is it locked down in any manner?
So my initial response would be that, if the county administrator, the CFO, and the county treasurer are able to, at that point, determine which of those funds were general fund dollars and which funds were, say, earned income, or dollars left over from the dedicated property tax levy. If they were to keep those dollars short, then I would say that the portion that's the general fund contributions could conceivably go back to the general fund and be used for pretty much anything, because the general fund is the catch-all. You can almost fund anything from the general fund. The other two buckets do have limitations and could most likely only be used for some long-term care related expense. Now that in itself is a pretty broad statement, in that you could use it to look at new service delivery programs if you wanted to get into some type of elder care related service delivery, not operating a nursing home, but there are other things out there. Say you wanted to do, our own version of Senior World, so that's adult daycare. If we wanted to get into that, if a future board wanted to get into that business line, those dollars could probably be used for something like that. So there's flexibility and options for that future board to have those types of choices should they want to do that.
Obviously, we don't want them to. We want this money to be sitting there to be able to pay off those bonds in 9 years. And hopefully, some of us will still be around the horseshoe and, we'll push that issue. But we're long-term strategizing here because I know I do, I want to pay off these bonds as soon as we possibly can. Are there any other questions? Jennifer?
Is there a way to make note of this intention somewhere? I'm thinking, of the State House and you have legislative intent behind things, but there have been things that have evolved that we've spoken about that some of us that were newer on the board had no idea that was the intent, 10 years ago. So is there somewhere we can kind of make note of these things as they evolve on?
I think from my perspective, and I'll maybe let Heather add to my comments, I think maybe for us the best way to memorialize this is to write about it and talk about it in the budget book every year, so that we've got that documentation. It's something that you all act upon on an annual basis, and as long as we're transparent and we disclose it in the budget book each year, and that's a great way. Odds are, I'm going to bet there's going to be a notation in our financial statements also. But Heather could probably speak more to that.
I'm just making a note. I think that, writing about it in the budget book is a great way to do that. I also think if the future boards look back to the resolutions to understand why, I tried to kind of write it into the resolution what the intention was. And I can also, in my monthly updates to the board on the agenda for the Headington Oaks, I can also write a narrative and just have it recur each month so that it's fresh in everyone's minds. If there are other ways I can think of, I think that's a great point.
Rob?
Can we be very specific in the name of the fund? Like repayment of bonds fund? So it's very in your face, this is what it is?
Well, under accounting rules, it is the long-term care fund. I don't know if we can really rename the fund.
Parentheses after.
But I'm sure we can figure something out.
Yeah.
And I know, just to follow up on Mr. Rosenbaum's question, or no, maybe it wasn't Mr. Rosenbaum's question, I apologize. I mean, it was Ms. Daly's question. I think Heather has some additional information on that as well.
Yes. So something happened before I was here that Scott made me aware of, which I appreciate, that there were funds used in 2020 from the general fund to pay off the internal loans to the long-term care services fund. The negative balance that has grown since then is due to all of the accounts receivables that were not paid that we've been trying to collect on. And so I also wanted to mention that anything that we receive over $275,000 in additional receivables will contribute positively to the fund balance because we've written off so much and allowed for these accounts. It's a negative in the reserve fund, not for the cash balance, but any cash that we receive above and beyond what is still technically on the books will contribute to the fund balance going forward. Hopefully that helps.
Thank you for that, Heather. Okay, Paul?
At the rate that we're going, with our surpluses and that, let's say we have a few more good years before we don't have as much, how many years has anybody projected how many years it would take to reach 11 million? And then where we wouldn't have to, then we wouldn't be charging the 6 cents anymore for the taxes, right?
No, you would, so Heather's breaking out her laptop because we have done that analysis, Mr. Rosenbaum. But we would still be needing, through the taxes payable in 32, we would still need to levy on an annual basis enough money to obviously make the debt service payment. If by some reason we were able to get to 11.7 million, say 3 years in advance, then that county board, could make a decision as to whether or not you want to levy the entire 6 pennies or not, or levy the entire 6 pennies and not make the transfer from the general fund. Because the way we've got the policy drafted for your consideration is that general fund surplus transfer only happens, one, if there's a surplus, and two, when we're less than 11.7 million. Once we hit 11.7 million, that transfer gets turned off. But Heather, now that she has her laptop open, she can talk a little bit more about projections.
It takes some time to do that. So like I mentioned before, I'm really conservative in my projections, but if we do a realistic $1 million a year from the general fund surplus that would be transferred in, we would have, if it's only a 1 million, we could have that amount built up by 2030. So we still want to levy the full 6 pennies, because you have to remember we're paying, $1.6 million a year on top in our debt repayment with the principal and interest also. So, I would say about 2030 projecting out, we'd have that 11 million and some change from there.
Thanks for that question, Paul. Any other questions or comments? Rob?
Quick question. So the debt repayment has to happen first? It can't happen, we can't do the debt repayment when the bonds are callable, so that money would earn more interest?
So we have regularly scheduled payments that we have to make each year for principal and interest payments. And there's very specific timing on those. We can't do those early and we cannot do those late. So at the end of, once they're callable on December 15th, 2032, the board then can make a decision to pay them all off then if they want, or any time after that date.
I'm sorry, I don't think I was clear.
Sorry.
I was meaning more the negative balance that we have in the fund that we have to repay first before we can start earning interest. Can we repay
Correct.
that part back when the bonds come, so we can earn more interest on this money?
So
Delay the repayment of that negative balance.
So the interest is earned on the balance in that specific account.
Okay.
And so if it's negative, until it's positive, we can't earn interest on that.
Gotcha. Okay. And last, I just wanted to thank you for your leadership in this. I know this was something that you pushed hard for, and you're doing a great service for our community, and something I'm proud of. So thank you.
Okay. Any other comments? Okay. All those in favor? Aye. Are there any nays? Okay. Next one is the FY 2024 General Fund to Long-Term Care Services Fund transfer. Did I miss one? I think I did the general fund surplus, didn't I?
Yes.
Yeah, okay, all right. So I get a motion to put that on the floor? Linda? Rob? Okay. Do you want to make any comments on that?
This is the one to transfer from the general fund to the long-term care services. This just gives Administrator Sorrell the authority to make those transfers as they're necessary in early next year.
Okay. Any questions? Okay, all those in favor? Aye. Any nays? Okay. Moving on, FY 2024 tax levy ordinance revision. Can you quickly go through this again? Thanks.
Do I need a motion?
Need a motion? Eden, Linda?
Okay, so this resolution will change the tax levy that you voted on in October, and it changes it by decreasing the IMRF by 1.1 pennies, the FICA by, it's different on here because this is in total. We had made some changes on there. By 1.0 pennies, and the risk fund by an additional 2.4 pennies, shifting those to the general fund levy so that it's levied at the full 25 pennies. And it has no effect on the overall taxes. It would just shift those to the general fund so that Administrator Sorrell can make that transfer in fiscal 24.
Yeah, the tax levy will remain the same. We're just
Yes.
moving things around.
So
Any questions on that? Okay. No questions? Steve?
When in '24 would that transaction transfer take place? Probably this time of year or before the budget, or is there a proposal of when?
I would say after property taxes have been received. So June, September are when they're due. That would be,
I would say, as the treasurer distributes property taxes to taxing bodies, including us, there would be incremental transfers throughout the second half of the year as those distributions are made versus one lump sum distribution.
Any additional questions? Okay. All those in favor? Aye. Any nays? Okay. Moving on, we are at public comment. Any public comment? Okay, we do have an executive session regarding cybersecurity audit, so I need a motion to go into executive session. Phil, second. Jennifer? All those in favor? Aye.